Imagine you've been winning at poker for 60 years straight. You've turned a $10,000 stake into a $1 trillion empire. You've beaten every crash, every bubble, every "this time it's different" moment the market has ever thrown at you. And then, right as the table is buzzing with excitement, right as everyone around you is doubling down on their best hands, you quietly slide your chips off the table, stand up, and walk out the door. That's exactly what Warren Buffett just did. On December 31st, 2025, the greatest investor in human history retired. But here's what most people completely missed underneath all the farewell headlines. Before he left, he spent 3 quiet years selling $184 billion worth of stocks and piling every dollar of it into U.S. Treasury bills. Not AI stocks, not the hot tech names everyone else was chasing. Treasury bills. Right now, Berkshire Hathaway is sitting on $382 billion in cash. That's enough to outright buy nearly 480 companies listed on the S&P 500. So here's the question you should actually be asking yourself. Why would the world's greatest investor cash out at the exact moment everyone else is all in? And more importantly, what does it mean for your money? My name is Seb, and I spend an embarrassing amount of my time reading the financial decisions of billionaires so you don't have to. I help regular people understand what's actually happening in the markets, not the version the financial industry wants you to see. Before we dive in, let me challenge something most people take for granted: the assumption that if the stock market is near all-time highs, things must be going well. Here's the uncomfortable reality. The most dangerous time to invest is often when optimism is loudest. The S&P 500's valuation metric, called the Shiller CAPE ratio, just hit 39.4. The last time it was that high? October 2000. 1 month before the dot-com crash wiped out trillions. Buffett didn't just retire. He left a warning note on the door. Let's start with the numbers, because they're almost impossible to ignore. 12 consecutive quarters. That's 3 full years of Berkshire Hathaway selling more stocks than it. Not a one-off portfolio adjustment, not a tax move. 3 full years of deliberate, consistent selling. Net total, $184 billion. To put that in perspective, that's more than the entire GDP of Portugal, just sitting in short-term treasury bills, earning a modest 3.6% annually. Here's the thing most investors completely miss about that 3.6% number. It sounds boring, right? Why would the greatest investor of all time settle for 3.6% when the S&P 500 was up double digits for 2 straight years? Because Buffett isn't settling. He's making a very calculated statement. He's essentially saying, I don't see a single thing in the stock market worth more than 3.6% once you adjust for the risk you're taking on. That's not a man who's lost his edge. That's a man who has read this exact story before, twice, and knows how it ends. Let me show you exactly what that looks like historically. Buffett's personal favorite valuation tool is called the Buffett indicator. It measures the total market value of all U.S. stocks against the country's GDP. The long-term average is about 87%, meaning the stock market is normally worth roughly 87 cents for every dollar the U.S. economy produces. In January 2026, that number hit 221%. That's not just elevated. That is the highest reading ever recorded in the history of the metric. Here's where it gets really interesting. Buffett went quiet and started building cash in 1968 when valuations were stretched. The market then delivered some of its worst inflation-adjusted returns for the next 6 years. In 1999, he refused to buy dot-com stocks and was mocked on magazine covers for being irrelevant and out of touch. Then, the NASDAQ crashed 78% over the following 2 years, and he was the one still standing. This is the 3rd time he's made this move, and this time, he retired right as he was pulling the door shut behind him. Now, here's what this means for your brain. Because your brain is genuinely working against you right now. There's a psychological phenomenon called herding behavior. and it's one of the most dangerous forces in all of investing. When markets go up, your brain releases dopamine, the same chemical triggered by a gambling win. And the longer markets stay elevated, the more painful it feels to sit in cash. Every day the S&P 500 ticks higher without you feels like a personal loss, even though you haven't actually lost a single dollar. This is exactly why most retail investors end up buying high and selling low. Not because they're uninformed, but because their brain is literally wired to chase whatever is already going up. Research from Dalbar, which tracks real investor behavior over time, found that the average retail investor earned just 4.2% annually over the last 20 years. The S&P 500 returned 9.5% over that same period. That enormous gap isn't the market failing investors, that's investors failing themselves, letting emotion drive decisions that math should be making. Buffett's actual greatest skill has never been stock picking. It's been the emotional discipline to sit on massive piles of cash, get called irrelevant by every financial pundit on TV, and wait. Most people can't do that. And the financial industry, frankly, is designed to prevent you from doing that, because advisors get paid when you're invested, not when you're waiting. Let me paint you a picture of what the math actually says about where we are. The Shiller CAPE ratio smooths out corporate earnings over a full 10-year cycle to filter out short-term noise. Right now, it's sitting at 39.4. The long-term historical average is 17.3. In every single period where the CAPE has been above 30, the average annualized return over the following 10 years has been around 3.1% per year. Compare that to periods where the CAPE was below 15. Average 10-year returns jump to 13.2%. Same index, wildly different outcomes. The only variable? The price you paid to get in. The math is brutal. You can't control what the market does next month, but the price you pay today is the single biggest factor in determining what you'll earn over the next decade. That's not pessimism. That's arithmetic. This is what nobody in the financial media talks about, because be patient and wait doesn't generate clicks. It doesn't sell ad space. It doesn't produce trading commissions. So instead, you get breathless coverage of AI stocks and new all-time highs, while the most successful investor in history is quietly parking everything in treasury bills and walking away. So what do you actually do with this? Here's where most people completely mess this up. They hear the market looks expensive and immediately panic into one of two terrible decisions. They either dump everything and try to time a crash, which almost never works out, or they dismiss the whole thing and keep buying with their eyes closed. Here's the more boring, more useful path. If you're in your 20s or early 30s, and you're consistently dollar-cost averaging into low-cost index funds every single month, keep going. Don't stop. A potential correction could be 2 years away or 5 years away, and the cost of missing out during that window is enormous. For long-term investors, time in the market still beats trying to time the market. But if you have money you genuinely need within the next 3 to 5 years, a house down payment, a career change fund, an emergency buffer, parking that specific chunk in a high-yield savings account, earning 4% to 5% right now, isn't being fearful. It's matching your money to your actual timeline. That's just good planning. And if you find yourself tempted to chase whatever's trending because you're scared of missing out on the next big move, that's the exact moment Buffett would tell you to slow down. His entire career is built on one principle: be greedy when others are fearful, and fearful when others are greedy. Right now, there is very little fear in this market. The Buffett indicator doesn't lie. Watch what Berkshire's new CEO Greg Abel does with that $382 billion. The day he starts deploying it aggressively back into equities, that will be one of the loudest buy signals in financial history. That's the moment to get bold, not before. Warren Buffett built a 6 million % return over 60 years, not by being the most aggressive person in the room, but by being the most patient. Subscribe if you want more videos like this.